Welcome back everyone. In this new lecture we are going to discuss about the money market part, the money market hedging, how to do or how to hedge the foreign currency risk through money market hedging. If we go through the charts in the risk management, you can see under the decision, if we take hedging, that we want to do hedging, there is one part which is internal, the second part is external. Under external also there are two parts, derivatives and money market hedge. So every step that is required under money market hedge is given in this last part. Okay, but first let me explain that the concept of money market hedging. And it's pretty easy to understand the concept but difficult to retain the steps in mind. So if you will focus more on the concept, now what exactly is the objective, it will be very easy to follow the steps. So let's say these are the two countries. Now the very first thing to understand, this is INR, this is US dollar. So this is India, this is USA. Now the very first question is, when do you think the exchange rate risk arises? If Indian party sells goods to Indian customer, then there is no risk of exchange rate because both the parties are from the same country. If the US party sells or purchases goods from the US party itself, then there is no exchange rate as both the parties are from the same country. It's not about the parties. Practically the cash flow from one party to another party in this transaction is same, that is rupees. One party is giving rupees, another party is receiving rupees. In this case also, the example that I just told you, one party is receiving US dollar, other party is paying US dollar. So when only single cash flow is involved, and that too in their own country, there is no risk of exchange rate. The exchange rate risk arises only when there is a cash flow from one country to another country, whether it is going out or coming in. This is where the exchange rate risk arises. Right? The concept of money market is to frame a transaction in such a manner that at expiry or at maturity, whenever the receivable or payable has to be settled, on maturity, there should be no cash flow from India to USA or USA to India. If you are successful in framing a transaction in such a manner that on maturity, no country will send the cash flows or will pay to other country. That means there will be no cash flow of foreign currencies. At that time, there will be no exchange rate risk, and automatically it will be called as the transaction is hedged. As the foreign currency is not involved at maturity, no exchange rate will be required to convert those cash flows. Now, the objective is, in order to hedge, understand the objective. Frame transactions in such a manner that at maturity, or we can say settlement date, there is no cash outflow or inflow from one country to another. And if we are successfully able to do this, then there is no need to know or find out the exchange rate of the maturity. And if we are not using the exchange rate of the maturity date, then there is no risk. And if we don't need the exchange rate at maturity, hence hedged. The exchange rate risk is hedged. Means what we are doing exactly is we are stopping the risk to arise itself. So then there is no need to hedging. And if we are creating no need to hedging, that is a kind of a hedging itself. That's it. There is no need to hedge now. Okay, how to do that? I will just show you now. Let me write down. I will again create two countries. And let's take an example that today Indian party has sold goods. So we are exporter in this case to USA. Okay, INR USD, and the amount is worth let's say for example 5 lakh or 1 lakh dollar. It means just look from this angle, exporter angle. After 1 year, let's say 6 months, after 6 months we will receive $1 lakh. We have a dollar receivable after 6 months. So after 6 months, this dollar is going to flow to India. Now, in order to stop this flow to India, we will have to create a situation exactly opposite to that. What if you have a payables of $1 lakh maturing on the same date? See, what if you have a payable maturing on the same date? What will happen? This party, who is the customer to you, is about to make a payment at the end of the 6 months of $1 lakh to you, and you have some liability at the same time in the same country. So you will also have to make a payment of $1 lakh to this other party. Let's say you are X, this is Y, this is Z. So what you will do is, instead of receiving $1 lakh from Y, you will ask the Y to make the payment to Z in his own country. So what we actually did is, we had foreign currency receivable. Okay. What we did is, we created foreign currency payable. Now you tell me one thing. What transactions are required today? What transactions are required today so that at maturity you will have to make the payment of $1 lakh to this party? Today, if you are borrowing dollar from America, if you are borrowing, let's say this is a bank. If you borrow dollar from bank today, what will happen? After 6 months, you will have to make the payment to Z, this bank. And how many dollars to borrow today? It should be the present value of $1 lakh. Let's say for example, present value of $1 lakh is 90,000. So at time 0, if you will borrow $90,000 from Z bank, let's say this is a bank, what will happen? After 6 months, there will be a liability of $10,000 interest and the $90,000 principal of $1 lakh, which will be settled with the receivable. This is the party, this is the customer who bought goods from you, and immediately what you did is you took the loan of $90,000 today in such a manner which is the present value of this 1 lakh, which is equal to this amount. So you borrowed this much of the amount so that after interest it becomes $1 lakh after 6 months, right? So you borrowed the dollars today. Now this is the today. You borrowed the dollars today, brought to India. What will you do with these dollars? You will sell the dollar by rupee at spot, isn't it? At spot rate, you sold those borrowings and received rupees, because according to RBI guidelines, you cannot hold the dollars. So the moment you will bring the dollars in the country, you will have to convert it into rupees. What did you do with the rupees? You immediately invested that rupees. And at expiry, what will happen? At expiry, at maturity, interest will be added to the investment and you will receive the proceeds. So this is going to be your inflow. At maturity, this is going to be your inflow. That's it. You don't have to make the payment to US party Z, because you will ask Y to make the payment to Z. So at maturity, there will be two things that will happen. This bank where you invested, let's say XYZ, and this is A. You invested that rupee with A bank. And what will happen? At maturity, A will make the payment to you along with the interest in terms of rupees, and Y will make the payment in his own country to Z bank on your behalf along with the interest. That means $1 lakh. So Z got the repayment along with the interest. He was about to pay to us. He paid to the bank. That's it. His liability is over and our liability is also over. This bank's liability is also over. We got the money at the end. At maturity, there is no cash flow from one country to another country. Let me explain that with the help of timeline. So today we have sold some goods, and for that purpose we will receive dollar from our angle. We have a dollar receivable at the end of 6 months. In order to remove this, remove the need of cash inflow at expiry, at maturity, we want to create such a situation that there is no need to receive or make the payment of dollars to the other country. You will have to create exactly opposite situation of the same amount. If you have dollar receivable, create dollar payable. Now understand how this situation can be created. If you borrow dollars today, from America, after 6 months you will have to add interest in that and you will have to make the payment. So this is how the liability can be created after 6 months. So you will have to borrow the dollars. Okay. After borrowing the dollars, you will sell the dollars in India and buy rupees at spot rate. Once you buy the rupees, you will invest that rupees with the Indian bank. And what will happen at expiry? At maturity, the Indian bank will add the interest to your investment and they will pay you rupee value. So at maturity, you will receive rupees, and at maturity, this party will make the payment to this bank in their own country. We are not required to make the payment in dollars at maturity or receive the payment in dollars at maturity. We are just receiving this. So at maturity, investment proceeds will be received by us in terms of rupees. So no exchange rate risk. And we will ask both them to settle with each other because the liability and the asset are of same value. So what happened? We had $1 lakh receivable. We created $1 lakh payable. How to create that? Whatever is the interest rate for 6 months in terms of dollar for borrowing, we borrowed that amount, and let's say for example it was 90,000. So $90,000 borrowed today will become $1 lakh payable after 6 months, which we are not going to pay. We will ask this party to make the payment to the bank. Now $90,000 borrowed today will be sold in the spot market to receive rupees. Let's say we are receiving 50 lakh rupees. And with that 50 lakh rupees, we are going to invest in some, let's say, whatever the bank is, A bank. That A bank will give us interest of, let's say, 2 lakh rupees. So at the end, we will receive 52 lakh rupees. That's it. There is no need for the exchange rate at maturity. The only three things which is required is, I will tell you, interest rate of domestic country, interest rate of foreign country, and the spot exchange rate. Exchange rate for the spot is required. When you will sell the dollar and receive rupees, that is required. Only three rates will help you. Only three information. These information will help you to create a transaction in such a manner that you will not have to make foreign currency outflow or inflow at maturity. And if it is not required, then there is no cash. Then there is no risk of exchange rate fluctuation. See, you are receiving from India itself instead of this party. And this party will make the payment to the bank in the America. So let me write down. In case we have foreign currency asset means receivable. Receivable, asset, or we can say receivable. Just a second. This is asset, or you can call it as receivable. This is created only when we are exporter. So if we are exporter, we might have sold the goods to someone else from whom we are going to receive. So if we are having a foreign currency receivable or asset, we will create foreign currency liability, or we can say payable. So that liability after 6 months can be created only when we borrow today, right? Why we will have to make the payment to someone after 6 months? Only when we have taken the money today. So we will borrow. What are we going to do? We are going to borrow foreign currency equivalent to the present value of the foreign currency asset. So this is 1 lakh that I told you. We want to create the similar liability after 6 months. And in order to create a $1 lakh liability, we will borrow $90,000 today. Now we will convert that at the spot rate. So we will sell the dollar and receive rupees at spot rate. After that, this rupee received by us will be invested. It's automatic, sir. We borrowed dollar from America to India. What are we going to do? Sell it. Once we borrowed it, we are not going to buy and add more dollars to it. Just keep closing the position. Okay. Borrowed the dollars, that means inflow. Now create outflow. Sell the dollar. After selling the dollar, you will receive rupees. Invest rupees. So let me repeat it. Just look at the actions. After every action, I will be just doing the opposite action. Okay. We have a foreign currency receivable. We want to create a foreign currency payable. For that purpose, we will have to borrow foreign currency today. If we borrow foreign currency today, what will happen? After borrowing, we will sell foreign currency at spot rate and receive the home currency, that is rupees. That rupees received will be invested back at the Indian bank, and that's it. The story at spot rate is over. And at the end of the 6 months, you will receive the rupees along with interest. So it's just one-to-one action. If you are bringing the cash flow, just make sure that it is going out. It's very easy, sir. Coming in, going out, coming in, going out. After every inflow, there has to be outflow. Now, if you have a liability, let's say you are an importer, what will happen? You have a foreign currency liability after 6 months. You create a foreign currency asset. Why do you think after 6 months you will receive money? When What action is required today? Just imagine what action is required today so that you will receive dollars after 6 months. Investment. Invest dollars today in America, and only then you will receive. So for that investment, just understand, for investing the dollar, you will have to first buy the dollar at spot rate. And in order to buy the dollar, you will have to pay rupees to the exchange, the bank. In order to pay that rupees, you will have to borrow rupees from the Indian market. Just like this. I am doing the calculations for the importer. We have a foreign currency liability. Because we have imported goods, we will have to make a payment of, let's say, for example, $1 lakh. That is called as foreign currency liability. Or you can say payable. Let's say it is payable. So if it is payable, what will be the next action? Do something so that after 6 months, you have a receivable from that country. Only then both of them can set off with each other, na? Why do you think we will receive money in terms of dollar after 6 months? This is only possible when you invest dollar, the present value of 1 lakh, invest dollar in America today. Along with interest, it will become $1 lakh. When do you think you can invest the dollar? First, you will have to buy the dollar. And in order to buy the dollar, you will have to make the payment in rupees, let's say 50 lakhs. And to make the payment in rupees to the bank to buy the dollar, you will have to first borrow that rupees from India. That's it. And what will happen? At the end of expiry, 2 lakh rupees will be added, and you will have to make the payment of 52 lakhs in India itself to the Indian bank from whom you borrowed. So what is the first transaction? Just imagine. You borrowed 50 lakh rupees. You paid that 50 lakh rupees to buy $90,000 today itself. And then you invested that $90,000. All this transaction happened at spot. Once you invested $90,000, you automatically created an asset there. So at the end, at the expiry, there will be two things that will happen in one country and in the other country. So let's talk about them first. At expiry, you will have a receivable from this bank. You will ask this bank to make the payment to this person from whom you have imported goods. So this vendor will be happy that he has received money, and the bank had to make the payment on our behalf. They had paid to this company. They have paid to this company. But what will happen in India? Since we have borrowed this 50 lakh rupees, we will make the payment here along with the interest. So that's the only cash outflow to us. See, if we are importer, there will be a cash outflow, but instead of a cash outflow in dollars, we will be paying only in rupees. And in this case, since we are exporter, there is a receivable. We will receive, but instead of receiving in dollars, we will receive in terms of rupees. So we are creating a situation in such a manner that there is no cash outflow or inflow from one country to another country. And if we can avoid the cash flows from both the countries, then there is no need for the exchange rate at expiry. And that's it. There is no exchange rate risk. We'll solve some questions and you will get to know about it. But make sure that the steps are only like this: inflow, outflow, inflow, outflow, inflow, outflow. More explanation along with the questions. See, this is the question number 79. An Indian exporting firm. So we have exports here. Just a second. So we have exports here. Would be covering itself against a likely depreciation in pound sterling because it is export. So we are worried about the depreciation in foreign currency. We have a receivable of 5 lakh pound. Okay. The spot rate is given to you rupees per pound. Payment date is after 3 months, and the interest rate of both the countries are given. So see, this is the first information, second information, and third information. Along with what is receivable and payable, there are only three things which is required for the money market hedge. What should the exporter do? In the entire question, there is no hint that you will have to use money market. But tell me, besides money market, there is no data for option contract, no data for futures contract as well, no data for the forward contract as well. Now you might be thinking that we can calculate the forward rate. Let me tell you, you can calculate the forward rate using interest rate parity theory, because the interest rates and the spot rate is given. But that is called as theoretical forward rate, which is not quoted by the bank. This is the theoretical rate. You cannot assume it as the actual forward rate. So unless and until the actual forward rate is given in the question, how can you enter into a forward contract? So forward hedging is not possible, future is not possible, money market is not possible. No information regarding the home currency invoicing. What should the exporter do? In this case, money market hedging is the best thing to do. And I will tell you step by step what exactly we are going to do. Since it is the first question, I will write each steps. Question number 79. See, we are the exporter. We have foreign currency receivables. How much? 5 lakh pound. Am I right? Yes. So, under money market hedging, create foreign currency payables. Create a situation in such a manner that after 3 months you will have to make a payment of 5 lakh pound to that company. So that what will happen, when this customer will be ready to make the payment to us, we will ask him to make the payment to this bank from whom we have borrowed. Why the payable will be there? Because we are borrowing. Borrow present value of payables. Understand, whenever you will write payables, it will be borrow. Whenever you will write receivable, it will be invest. So 5 lakh divided by, what should be the rate? See, you are borrowing pound. So pound rate is required, and that is per annum. For 3 months, it will be 1.25%, 5 divided by 4. 1.0125. Am I right? Discount it. Discount, because we want present value. So if we borrow 493,827 pound today, this is the spot borrowing. That means the bank who is giving us the loan in pound will ask for this interest in 3 months, which will make the total payment to 5 lakh. And this is how the payables will be created. Now we have borrowed the pound, bring it to India. What will you do after borrowing? Borrowing the pound, what will you do? You have to sell it in the spot market. Sell pound in spot. So see, this is receivable, this is payable, this is received. Now we will make the payment again, 493,827. And by selling those pound, we will receive rupees. See, what is the rate? 56 rupees. At 56. 493,827 into 56. That's 2765, 4312. 2,76,54,312 rupees received. What will you do with the rupees? Invest. Invested. Okay. What else is required? Nothing. That's it. The story at time 0 is over. Okay, sir. After 3 months, at T3, what will happen? This investment will mature. We will receive this investment. Investment proceeds. 276,54312 into, at what rate we invested? 12% per annum. For 3 months it will be 3%. So the amount that we will receive is 28483941. That's it. The end of the story. You don't have to do anything now. You will at the end of 3 months, you will ask this party, the customer, to make the payment to this bank from whom you borrowed money. That's it. This bank will not ask anything from you. The customer will not give you anything as well. These parties will settle with each other in their own country. So they don't have to send any cash flow. They don't have to send any currency to India, nor they will receive anything from India. That's it. The story is over. This is the investment proceed. Ask the other two parties to settle with themselves. Where is the need of the exchange rate risk at expiry? There is no need. So no need for the hedging as well. The final amount of receipt is 2,84,83,000. See, we are the exporter in this question. That means we will receive something, not in terms of pound, but in terms of rupees at the end. 28,483,941. This is 28,483,941. That's it. That is what the customer should do. The company should enter into a money market hedge. Let's have a look on question number 80. Sun Limited is an Indian company. Will need, that means payable, $5 lakh in 90 days. We have a foreign currency payable. In this connection, following information is given to you. Spot rate rupees per dollar, 90 days forward rate 73. Interest rates are also given. So if you are borrowing or depositing in India, the rates are like this. The deposit rate is of US and India, borrowing rate of US and India. Now, a call option, understand, a call option on dollar that expires in 90 days has an exercise price. Just understand, we need $5 lakh to make the payment to vendor. That means we will buy these dollars first after 90 days. So we need the dollar buying right. And that's why they have said call option. Even if the question misses out on writing call or put, you need to make sure that the dollar is the base currency and call option is the answer. If rupee is the base currency, then you will buy put option, because by selling rupees you will buy dollar. Okay. And an exercise price of 74 rupees and a premium of 0.10 rupees per dollar. Sun Limited has forecasted the spot rate after 90 days to be like this. So these are the possible spot rates on that date. Which of the following strategy would be the most preferable to Sun Limited? See, we have a payable. In whichever option the payables are least, that option will be preferred. So let's first try forward contract. If we buy $5 lakh under forward contract, 5 lakh into 73 will be the answer. That's 3,65 lakh rupees. Cool. That's easy. Forward market, 3,65 lakh. Now let's come to the money market. I will just solve this question here. Question number 80. We have foreign currency payable, right? Just keep doing exact opposite. How much? $5 lakh. So what should you do now? After 90 days, you have to make the payment of dollars. Create a situation that after 90 days, you have a receivable, that you will receive something, and something, it's exactly $5 lakh. So create a situation that you have a receivable of $5 lakh after 90 days, so that you can settle both at expiry in the same country. So you have a payable, create receivable. Why do you think someone or a bank will pay us after 90 days? This is only possible if we invest with them today. So invest present value of dollar. See, we cannot invest 5 lakh dollar today. If we invest 5 lakh dollar today, the maturity value will be more than 5 lakh. And that will create an issue. We have to make sure that the receivable and the payable at expiry is same. So invest the present value of dollar. Okay, present value of the dollar. We want to invest dollar. So the dollar depositing rate is required. Am I right? Dollar depositing rate is required for 90 days. So have a look. Dollar deposit rate is 2.5%. And all these rates are per annum, I think. Yeah, all these rates are per annum. How did you know, sir? Sir, it's very simple. 90 days borrowing rate, if you consider 90 days borrowing rate as 4%, for the entire year it will become 16%, and this will be like 36%, 24%. Very huge. So all these rates are per annum. You have to convert it into 90 days. So is the question giving you something like 360 or 365 days? No. So we'll consider 360 days in this question. Okay. So what will be the rate then? Let me check. 2.50 divided by 4. The rate will be 0.625. In this case 1%. In this case also 1%. And 6 by 4, in this case 1.5%. So I have converted all the rates into 3 months rate. So 0.625% is the deposit rate for dollar. 1.00625, I think. 1.00625. So how much amount I should invest? Invest means there will be an outflow. 5 lakh divided by 1.00625. That's 496. 894. This much of the dollar you have to invest today so that it becomes 5 lakh dollar, which becomes receivable from the bank, and we will ask the bank to make the payment to the vendor. How will you invest this dollar today? First, you will have to buy this dollar. Buy dollar at spot. So let's buy it. 496,894. At what rate? The spot rate. 71 rupees. Step by step. So this multiplied by 71. 496,894 into 71 goes to, you will have to pay 3,52,79,474 in order to buy this much of the dollar and then invest in America. But how come you are going to pay this much of the rupees? You will have to borrow rupees at rupee borrowing rate. 90 days borrowing rate for rupees 1.5%. This 6% per annum. So you borrow rupees 352,79,474. See the transactions. You have a payable, you are creating a receivable. For that purpose, you will have to invest. Before investing, you will have to buy those dollars. And if you are buying the dollar, you will borrow rupees. See, investing the dollar, borrowing the rupees. Exact opposite. In order to buy the dollar, you will have to make the payment in rupees. And that rupees will come only after you will borrow it. So these are the transactions that will happen, and at expiry what will happen? You will just add the interest to it and make the payment to Indian bank. No cash flow from one country to another country. Repayment 35,27,9,474 into 1.015 for 90 days. So the total outflow will be 35, 80, 86. 80, 86, 66. That's it. 3 crore 58 lakh. So this is the outflow. 3 crore 58 lakh 8,666. Now there is a problem in this question. We have assumed these rates to be per annum, since in most of the question they have used it per annum. But what they did is they have taken the entire rate of 2.5% and 6%. So it all depends upon the assumption. They have not converted all those rates into 3 months because they have assumed it as for 90 days itself. So be with it. We have one justification for what institute has done, because nothing in this entire question per annum was given, but my suggestion was like that. That's okay, not a problem. We can go with this one also, but if you are going for per annum, you will have to make a note of it in the exam. Okay, sir. So I will just assume this will be the answer, 367, after taking the entire 2.50% deposit rate of dollar and 6% borrowing rate for rupees. But you might have understood the procedure by now. And which is exactly opposite of this thing. See, the previous question was of exports. So you can clearly compare that where we are borrowing, in this case we are investing. We were selling the foreign currency, we are buying the foreign currency. We were investing in rupees, we are borrowing in rupees. Exact opposite is going on. So if you ask me to write down the things, it will be like this. We have foreign currency receivable, then create foreign currency payable. Okay, this is for exporter, this is for exporter, and this is for importer. So in order to create payable, we will borrow foreign currency. And how much? Borrow present value of foreign currency. Once you borrow it, sell foreign currency at spot. So once you sell it, you will receive rupees. Or we can say, if you will sell foreign currency, it means you are buying home currency. Okay. Once you bought the home currency, invest home currency, and at maturity receive investment proceeds. That's it. These are the only transactions required every time in case of exporter. Now, in case of importer, we have foreign currency payable, create foreign currency receivables. Exact opposite of that. In order to create foreign currency receivable, we will have to invest. How much? Just a second. Invest present value of foreign currency. Now, in order to invest, you will have to first buy that foreign currency. Buy foreign currency at spot. And for that, you will have to sell home currency. Once you sell the home currency, you will be able to buy the foreign currency, right? In order to sell the home currency, you will have to borrow home currency. And at maturity, what will happen? Pay repayment of borrowings. That's the only outflow. This will be settled here and this will be settled here. See, what are the points? We have receivable, payable, receivable. We have borrow in this case. In this case, we have invest in the foreign currency. We are selling foreign currency. Here we are buying foreign currency. We are buying home currency. Here we are selling home currency. We are investing home currency. We are borrowing. Exact opposite of both. So this is the case of exporter and this is the case of importer in case of money market hedge. Okay, sir. Now coming to the option contract. This is an interesting part. What will happen in the option contract? At expiry, you have the spot rates. At every spot rate, you will first decide whether you are going to exercise the option or not. See, the option price is 74. That means you can buy every dollar at 74 rupees. So let's keep it 74, 74, 74. You know, call option is only exercised when spot rate is greater than strike rate. This is the spot rate. This is the spot. These are the spot rates and this is strike rate. And you can clearly see that only in this case spot rate, in the last case spot rate is greater than strike rate. So only in this case the option will be exercised. Otherwise, not exercised, not exercised. When you are not exercising the option, the payoff under option will be 0. You will not receive anything from the option. But if you exercise the option, you will have something in payoff. That means the exercise price will be 74. Now the applicable price. See, our purpose is to buy the 5 lakh dollar. If 72.50 is the market price, we are not going to buy the dollars at 74. That's why we are not exercising. So what will be the price of buying the dollar? 72.5. In this case, 73 rupees, the spot rate will be the buying price of the dollar. And in this case, it will be 74 rupees indirectly. Practically speaking, we will be buying the dollar at market rate of 74.5, but there will be cash inflow of 0.50 also again. So we will receive this and we will pay this. At the expiry maturity, in order to buy 5 lakh dollars, we will pay 74.50 in this case. But for the same amount, we will receive this much of the gain by exercising the option. So outflow of 74.5, inflow of 0.5 will lead to 74. So if we are exercising the option, we will say that 74 is the net price that we will pay, not this one. That's it. Multiply it with the probability and you will get the expected price at which you are going to buy 5 lakh dollar. Apart from this, there is one more cash outflow, which is the premium. So if 5 lakh dollar is to be purchased, we have to make a premium of 50,000 rupees, and that too has to be made today itself. So 50,000 will be borrowed by you at 6% rate, on which you will pay interest. That will come to around 3,000. So 53,000 will be the repayment. Let's see the answers. See, 50,000 into 6%, 3,000 is the repayment. And you might say that 50,000 is also an outflow. It is not a deposit. Exactly. They could have showed 50,000 here, but instead they included that in this case. I will show you the transaction now. So they included premium in this case, and that's why 72.50 plus 0.10, 72.60. You can clearly see. So that is not a proper presentation. What they could have done is like this. Answer will be same. I will just show you. Just multiply it with the probability and let's find out the answer. 73 into 0.50. 72.50 into 0.25. 73 into 0.50 and 74 into 0.25. So that comes to 70. So understand. The expected price comes to 73.125, at which you will buy 5 lakh dollars. Okay, multiplied by 5 lakh. So that comes to 365, 62 and 500 plus 50,000 of the principal repayment and 3,000 of the interest. All of them are outflow. 366,155,00. Let's check this answer. 366,155,00. So we cannot say that premium is not included. It is included, but indirectly in this table itself. Okay, sir, let's move ahead. If we opt for no hedging option, what will happen? The expected price of, see, I will show you. If we opt for no hedging option, we will make the payment at the expected price of this. So you will have to take the future rate, all these rates, ignore this. Expected price, you will have to calculate the probabilities multiplied by the future rate. This will give you the expected spot rate. And in this, at this time, you will take 74.50. If you do not hedge, the expected spot rate will become your outflow. This multiplied by the probability. See, 72.5, 73 and 74.5. And the probability is this. The payment will be this. Now you have all the four options. You can see wherever the amount is less. As compared to no hedging, the amount is least in case of option. But let me just go back. 365, 367, 366 and 366. So forward contract is the most preferable option because we have a least payment in that. Do you understand how to solve this question now? Option contract was interesting, no? So we have a similar question here. In this case also forward, money market, option and no hedging. And you can clearly see this is a similar question. Instead of $5 lakh, we need pound, 3 lakh pound in 180 days. Instead of 90 days, it's 180 days. Spot rate, forward rate, interest for that 180 days is also given. Please consider these rates for 180 days, not for per annum. Okay. A call option again, because we need pound. We need means we want to buy pound after 180 days. So we need a buying right, which is called as call option. And this is the strike rate and this is the premium. For every pound, this much is the dollar that you have to pay. You are from US, not from India. So take this as homework, exactly similar to the previous question. Let's come on to question number 82. Yeah, we will solve this. This one is interesting. Forward, money market and option. Once again. And probably the last question on these topics. If there is a variety in the coming question, obviously I will go with the solving those. Otherwise I will give it as homework. Basic understanding should be there, na? Have a look. See, this is a very good question and the major part or the time in this question will be spent on the option contract. So you have to be focused because this is very, very critical to understand. This like the flows of transaction will, there are lots of flows of transaction in this. In order to make, in order to fulfill this transaction, we will have to create this. In order to fulfill this, we will have to create this and then this and then this. This is how the transactions are going to flow. A Limited of UK, that means your own currency, home currency is pound, has imported, you are a importer, so it's an liability, it's a liability to you. Chemical worth USD 364,897. So this much of the dollars has to be paid at the end of 6 months. This is the liability. The relevant spot and the forward rates are given to you. Spot rate, 6 months forward rate. And you can understand that these are in terms of per pound. So can I say these are indirect quotes because pound is also my home country and that's also the base currency. The quotations are in the form of foreign currency per unit of home currency. So whatever, please understand from the start I am explaining it to you, whatever you want to do with the bid and ask, first put the requirement in terms of base currency, which is GBP. Now, you want to buy USD to make the payment to the vendor. That means you will sell GBP. And if you will sell GBP, bank will buy GBP. That means their bid rate will be used most of the time. Mostly, not every time. This is how you have to consider. You will be buying dollars, selling GBP. Bank will be buying GBP. And that's the bid rate. Okay. The borrowing rates in UK and US are also given to us respectively, and the deposit rates are also given. So can I draw it here itself? UK, US. It will be easy for us. And then borrow, deposit. Borrowing rate in UK and US 7 and 6%. And deposit rates are 5.5 and 4.5%. And it is not mentioned that if these rates are per annum, and mostly I think they have used it per annum. Since it is not mentioned, you can consider anything for the 6 months. You can consider these rates are for 6 months also, but I know this has been taken as per annum now in this question. Let me just cross check it once again. Yeah, for 6 months they are converting the rates to 2.25%. So we are going to assume it as per annum. Mostly it is per annum. In the previous question also only it was like that. Currency options are available under which one option contract is for GBP 12,500. Understand, you want to sell GBP. You need a right to sell GBP. The option premium for GBP at a strike rate of this is 0.037 for call and 0.096 for put. You decide which option will you be buying. Call or put. We will buy the put option. Why? Because the base currency is GBP and we want to sell GBP. We need a right to sell, which comes under put option. So the premium that we will be paying for every GBP is 0.096. Okay. How many contracts can be entered into? That depends upon 12,500 of the contract size. Okay, sir. The company has three choices: forward, money market and option. Forward is the easiest one to calculate. A little difficult is money market, and the most difficult in this question is currency options. Recommend which of the alternative is preferable. We are the importer. Whichever option will give us the least outflow, that option will be preferable. Let's start with the forward cover and finish it off. $364,897. This is in dollars. Which rate is applicable? You want to buy dollars, but the dollar is not the base currency. You will sell GBP first. Bank will buy GBP. The bid rate is applicable after 6 months. This rate 1.5455. 1.5455. Now this is also dollar per pound. This is also dollar. That is also dollar. We will divide them. Do not multiply. So the pound payable is 236,103. End of the forward cover. Let's try the money market hedge. Now, for the money market, this is applicable. We have the payables in terms of dollars. We will create $364,897 receivable. We will we will invest the present value of dollar. Let's try it. I will do it faster. We have the liability of 364,897. We will create the asset of 364,897. In order to create receivable, we will have to invest dollar today. And how much? Invest present value of $364,897. So we want to invest dollar. Dollar deposit rate is applicable for 6 months. Deposit rate of dollar is 4.5 per annum. All these rates are per annum. So for 6 months, it will be 2.25. 1.0225. That will be 356,867. So we have to invest this much of the dollar, and in order to invest this much of the dollar today, we have to buy them first. Buy dollar at spot. So we will first buy them 356,867. What is the spot rate to buy the dollar? Understand that you are buying the dollar by selling GBP. Am I right? You want to sell GBP, which is the base currency. Bank will buy GBP. Bid rate at spot. Which one will be applicable? This one. Never make the mistake. GBP is the base currency. You will sell it to buy the dollars. 1.5617. 1.5617. Divide it. 356,867. 1.5617. So you will have to make a payment of 228,512. So once you will sell this much of the GBP, you can buy the dollars. And after that, you can invest the dollars today so that it becomes this much after 6 months, and you can settle it with the liability. Now, in order to buy the dollars, you had sold the pound, and in order to sell the pound, you will have to borrow them 228,512 for 6 months. And what will happen after 6 months? At expiry, you will make the repayment. So 228,512. What is the rate of borrowing for GBP? Borrowing rate for GBP is 7%. For 6 months, it will be 3.5% into 1.035. So the net outflow in the money market hedge is 236,510. See, all the things. I'm repeating, we had a liability of 364,897. We created receivable. For that purpose, we have to invest today the present value of what we want to receive. This is the present value that we invested, and before investing, we need to buy it today itself at a spot rate. Plus, please understand, if you are buying dollars, you are selling GBP, which is the base currency. If you are selling the base currency, bank is buying the base currency at bid rate 1.5617. Both the currencies are same, divide it. And in order to sell this GBP, you will have to first borrow it, for which you will make the repayment at 236,510. So understand, it will be 236,510. Okay? Clear with it? See, these are the same transactions. This was the amount payable. You invested the present value of it, and before that you purchased it for this much of the GBP which you borrowed. Along with the interest, you made the payment. So it's not that easy to understand. You might see that there are very less transactions in this table and it's easy to follow what has been done here, but try to understand this. Now, this is step by step. If you are comfortable with the money market hedge, confident with the money market hedge, you can remove the steps from this place. Ultimate answer should be this. That is what the institute says. Now come to the option contract. Last part of this question, option contract. See, first step, we want to buy dollar. That means sell GBP. Okay. And are you clear with this thing that this is the base currency under option also? Why? And how come you got to know about it? The size of the contract is in GBP. $12,500 GBP in one contract. So, what do you want to do at expiry? You want to sell GBP, which is the underlying asset. Second point, since you want to sell the underlying asset, you need a right to sell. Right to sell GBP is under put option. So buy put option. Am I right? Okay, sir. We will buy the put option. Contract value. The total value of contract in terms of GBP is $364,897 divided by the strike rate. Strike rate is $1.70 per GBP. So this is what we are contracting in option. 214,645. We want to sell this much. We want a right to sell this much of the pound at this rate so that we can buy $364,897. But we are restricted to number of contracts. The number of contracts will be 214,645 divided by 12,500 in one lot. So you have 17.17 contracts. Now, how are you going to buy exact $364,897? Sir, you cannot buy the entire $364,897 under the option contract. That is 17 contracts only you can buy it. it means we will cover $364,897 in two different contracts. Majority of them will be in option and the remaining will be in forward market. See, in option market, you are covering 17 contracts at 12,500. Okay, multiplied by 1.70. That means how many dollars you will be buying under option? 17 into 12,500. That comes to 2,12,500 into 1.70. You will be buying $361,250 from the option contract and the remaining under forward. How much? 364,897 minus what has been covered under option, 361,250. It means we will be buying $3,647 under forward. So all the calculations will be done under option contract itself. Step by step we are moving, okay? So this is what we are doing. Now the premium, time to make the premium payment. 6. Premium. See, we have to make the premium payment of $0.096 US dollar per GBP. Am I right? This is per GBP. So whatever the number of GBPs you have contracted under option, on every GBP you will have to make a payment of this much dollars, which is not your home currency. Let's calculate. Premium will be like this. 0.096. Let me just show you with a proper manner. 17 multiplied by 12,500. That means you have contracted to sell or agreed to sell 2,12,500 pound. On every pound you will have to make a payment of the premium of $0.096. That is what you need to understand. This is the premium on every pound out of this. And this has been calculated as 17 contracts that you have purchased for put option. Okay. Okay, sir. Okay. Let me just write it here. So the total outflow, the dollar required to make the premium payment is 20,400. Please understand, this is not your home currency. How are you going to make the dollar premium payment to the exchange? First, you will have to buy this dollar at spot. Okay, so what will you do? You will buy the dollar. But dollar is not the base currency, sir. In order to buy the dollar, you will have to make the payment of pound. You will sell the pound to buy the dollars. You will sell the pound, bank will buy the pound. Buy the pound means bid rate, which is 1.5617. Okay, sir. 1.5617. So 20,400 divided by 1.5617. You will make a payment of 13,063 pound first and buy this much of the dollar. This deal will be done with the foreign exchange dealer, means bank, and then take this dollar to the exchange, pay this dollar to the exchange as a premium, and then the exchange will sell 17 put option contract to you. You will be the buyer of the put option contract. Now the last question. How are you going to make the payment of this pound to the bank to buy dollar? You will have to borrow this much of the pound. Last step at spot rate. Borrow pound for 6 months. So you will first borrow pound of 13,063. See, this is going to happen. You will go to bank A to borrow the pound, and then you will go to foreign exchange dealer to sell that pound and buy dollars, and then you will go to exchange to pay that dollar and buy put option. This is, you will have to go through 3 different phases. I told you this. In order to fulfill this, you have to do this. In order to do this, you have to do this again. And this is the open transaction. It has to be settled at the end of 6 months with interest. You have borrowed the dollars, borrowed the pound. The pound borrowing rate is 7%. We will make the settlement at the end. Now there are 3 things which is open. Please remind yourself. One is the forward contract for that unhedged portion. Second is the put option contract. Third is the borrowing. Today, there are 3 things which are open, which has to be closed. I will show you this, and this. These are the 3 things which are open: exchange, forward party, and the bank. Settle them and you will get the outflow, total outflow. After 180 days, what will happen? I will show you. See, mostly what happens is that under put option contract, you will find out whether to exercise the option or not. But the spot rates at expiry is not given. That means you will go with the exercise rate. First, you will settle the option contract. That means you will pay 2,12,500 pound. Pay means you will sell 2,12,500 pound. You had the option to sell this pound, you will sell it, and in return you will receive $361,250. $361,250. Am I right? This was the contract. See, this was the contract. $361,250 by paying this much. 17 into 12,500. Now, for the balance $3,647, for the balance $3,647, you will pay under forward contract. See, in this case also you will sell pound at a forward rate to buy the dollars of 3,647. You will sell pound, bank will buy pound, which is the base currency at 6 months forward, which is 1.5455. So 3,647 divided by 1.5455. You will have to make a payment of 2,360 pound. This is the balancing figure, right? You need the balance dollars to make the payment to the other party, and you will buy the dollars, this much of the dollars at a forward rate, because this was the remaining or unhedged portion of the option contract, because you cannot do the take the option contract in fraction. Apart from these two, there is one more thing which is left, which is called as repayment of borrowing. You borrowed around 13,063 pound. 13,063, 1.035. 7% is per annum rate, 3.5% for half a year. So the outflow will be in pounds, 13,520. So you will receive $364,897 under option contract at the end of 180 days, but the total payment for that you will have to make is 228,380. This is the outflow under option contract. See what has been the transaction. I will request you to access the class notes from the app and then go through it once again if you find anything which is not getting into your head or which is difficult to understand. Step by step we have done everything. The most important part is to understand that for the fraction contracts we can go for the forward. For the unhedged portion we can take the forward rate, and it comes under the option contract itself. Because of the option we are going for the forward now. And in order to make the premium, which is not our home currency, we will have to buy it first. And in order to buy it, we will have to make the payment of home currency, which will have to be borrowed. So the premium transaction has taken these 3 steps, 6, 7 and 8. Okay, sir. 228. Let me just see. There is something missing here. My answer is 228, 380. Right. Acha, 3647 divided by 1.0. 13063. So there is one mistake that you can see here. This is right according to our calculation. 2360 also. See, 2360 and 212500. The only mistake that the institute has done is the premium was paid at 0 time and they have not considered interest on 13063, and that's why the answer is differing. Whereas the interest has to be considered because no one is going to give you free money. The premium has to be paid at this date. So this has to be borrowed, but they are taking 13063 at the expiry as well. So no interest has been taken here, and that's why the answer is not matching exactly. But this is not the correct answer, I will tell you. The interest has to be there. Ultimately, whichever option will give you the least amount of outflow, you will go with that. Forward gives you 236. Money market also gives you 236, and the option gives you 227, or we can say 228. And we will go with the option hedging. So it was worth doing all the calculations for option contract because of the least payment in that we can hedge this foreign currency payable through option contract. That's good, sir. Now this is a normal question. The next question is 83. You can see that we are exporter in UK and we will be receiving $350,000. We have been given with dollar per pound. That means this is indirect quote to us. Yes, because we are from UK, our home currency is pound and the base currency in this case is also pound. So be careful while picking up the rate. If you are receiving dollar, you would want to sell dollar. That means you will want to buy pound and bank will sell pound. Ask rate will be applicable most of the time. Interest rates are also given for dollar and pound, and compute and show how money market hedge can be put in place and compare it with the forward contract. So both the things has to be done here. Show the cash flow under money market hedge and the forward contract. We have discussed that. You need to practice it in this question. There is nothing new to be discussed, so that's why I'm putting it to homework. Question number 84. Let me see if something can be done. A simple question again. India and USA deposit and borrowing rate is given to you. 1 month, 3 month. Show Interfinance Limited with forward market or money market. The forward rates are also given. Purchase the good payable in 3 month. See, so 3 months rates will be applicable most of the time. I don't think so 1 month rate will be applicable in this case. So, and the rates are direct. You are receivable or payable. Let me just check. You have purchased the goods. That means this is a liability. You want to buy dollar. Dollar is the base currency. Straight and simple quotations are given. You want to buy dollar, bank will sell dollar, ask rate of 45 will be applicable in the forward market. Simple. And the money market hedge is as good as we have solved it. Create the asset. You have the asset, or sorry, you have the liability, create the asset. For that purpose, you are going to do the transaction. So I don't think so it will be difficult. Again, nothing's new to this question. Take it as homework. So this is again a simple question. There are only 2 things that you need to do. See, money market and forward market. Again the same thing. Forward rates are directly given to you. $50,000 receivable. That means, and the rates are also direct. Pretty easy to pick the rates. We will receive the dollars. We want to sell it. Bank will buy it. 72.95. The forward rate. Cool. This is very easy. Now comes the money market. Money market is that we have receivable, create payable, and for that purpose you will borrow the present value, and in order, after buying it, borrowing it, you will sell it in the spot market to the foreign currency, and you will buy the home currency, and you will invest that home currency, and the investment proceeds will be there. Now understand, 50,000, right, is the receivable. Create 50,000 liability, and for that purpose you will have to borrow the present value of dollar. Borrowing rate of dollar is 6%, that is per annum, and this is all for 3 months. So how many percentage for 6 months? $50,000 divided by 1.015, 1.5%. So 50,000, 1.015. How much you are going to borrow? 49,261. After that, this is the dollar. You will sell it. Bank will buy it at spot 72.65. This will be, you will sell this $49,261 and borrow 3578818 rupees. Invest 3578818. Invested rupees. Investment deposit rates of India are this 9%. How much for 3 months? 9, 4.5, 2.25 plus 2.25%. So that's around 3659341, the net amount that you will receive. 36,59,341. 36,59,341. Easy, very easy. Second part, let's have a look on the second part. Assume that H Limited anticipates the spot rate in 3 months time to be equal to the current 3 months forward rate. He is anticipating that this is going to be the expected spot rate. Okay. After 3 months, the spot exchange rate turned out to be this. This is the actual. What is the foreign exchange exposure and risk of H Limited? What is the foreign exchange exposure and risk of H Limited? It's very easy. First, convert at the forward rate. Expected realization as per the forward rate 36.47 500. Because they said that the forward rate and the expected spot rate will be same, so the values will also be same. We have expected that we will receive 36,47,500, but in actual the rates turned out to be 73 itself. We will sell the dollar, bank will buy it at the bid rate 73. So actually we received 36,50,000 instead of 36,47,500. So there is a gain. We thought we will receive this much because of the expected rate, but when the actual rate turned out, if we do not hedge and convert it at actual, if we skip this process of forward hedging and money market hedging, that means we are keeping the position open, unhedged, and at the end we will convert at this price, actual realization, that is 3073. So we will receive more than the spot rate but less than the money market hedge. So we will receive more than forward but less than money market hedge. So we should go for the money market hedge in that case as well. We should have. Let's come to the question number 86. This is interesting. Columbus Surgical Incorporation is based in US, so our home currency is US dollar. Has recently imported surgical raw material from the UK. So we have a GBP payables and has been invoiced for 4,80,000 pound. We have to make this payment in 3 months time. It has also exported. So we are the importer and exporter both in this question. Surgical goods to India and France. Okay. The Indian customer has been invoiced for pound. Just understand, India's currency is rupees, but still we have given him the invoice in terms of pound, not rupees, which is also payable in 3 months. So for us as an American, this is receivable in 3 months time. Also 4,80,000 pound is payable in 3 months time. We are going to match this. We are going to match this. Indian customer has to make the payment to us of 1,38,000 pound. What we are going to do, we will ask the Indian customer to make the payment towards this liability of ours, and the balance liability will be paid by us. So we can reduce the transaction cost as well. Okay, because the timings is also same. And the French customer has been invoiced for 5,90,000 euros payable in 4 months time. So first of all, the French customer has a different currency of invoice, which is euro, and the timing is not also matching. So we can keep this French receipt separate, and we can match this pound payable and pound receivable, and the net pound payable should be taken like into hedging purposes. Now these are the spot rates. Understand, this is pound per dollar. That means this is indirect quote for us, and the base currency is dollar. Our own home currency is the base in that. So in this case, if we want to pick the rates from here, we will have to make sure that we put the requirement in dollars. In this case, the rates are dollar per euro. So this is the base currency. Current money market rates are as follows: UK, France, USA. And this is the bank's buying rate and selling rate for money. If the bank is buying money, that means this is our deposit rate. Our deposit rate. This is our deposit rate. And this is our borrowing rate. If you are confused about the rates now, if you get confused anytime, understand that bank will always give less interest and receive more. Bank will pay less interest on the deposits and more will collect more interest on the borrowings. So borrowings will be costlier for us, which is this rate 12. 12 is higher than 10, 16 is higher than 14, 13 is higher than 11.5. Once you understand how the banks does the business now, it will be very easy for you to pick the rates. Bank will always buy money from you or take the deposits from you and pay less interest, and the same deposit will be given to someone else as a loan, and they will collect more interest on that. So 12%, 16 and 13 is the income to the bank. This is the outflow of the bank. Okay. You as a treasury manager are required to show how the company can hedge its foreign exchange exposure using forward market and money market hedge. Suggest which is the best hedging. So this question is little easy, but the only thing is about the pound. What we can do first is we can ask the Indian customer to directly make the payment to the UK party, and we will only be liable to the UK party for the balance amount. Pound exposure. Let's read it. Since Columbus has a pound receipt and payment maturing at the same time, it can match them. This is called as the concept of matching, which comes under the internal hedging part, and against each other leaving a net liability of 3,42,000 pound, which can be covered under forward. Now after 3 months we have to, let's say we will go for this forward contract. After 3 months we have to pay pound to the other party. We want to buy pounds, but here dollar is the base currency. Buy pounds, that means sell USD, which is the base currency. Bank will buy USD, and that too after 3 months. Bank's bid rate will be applicable, 0.9520. This is pound, and 3,48,000 is also 42,000 is also pound. Both the currencies are same. Divide it, 0.9520. See, 0.9520. So how many dollars you will have to make? You will have to pay 359,244. Now let's go for the money market hedging. We have to make the payment. We have a liability. We will create the asset in UK. So I'm just writing everything in short. We have a liability of 3,42,000 pound after 3 months. Create asset of 3,42,000 pound. In order to create the asset, we will have to invest the present value of the same today for 3 months. Okay, we will invest in pound, right? So we need a deposit rate of GBP. GBP deposit rate is 10%. Am I right? Okay, sir. 10% per annum. How much for 3 months? 3,42,000 divided by 1.025, 2.5% for 3 months. So you will have to invest 333,659 pounds, and before investing this much you will have to first buy it. Okay, sir, let's buy it 333,659, and in order to buy this pound you will have to sell the dollars. How much you want to sell the dollars today? This is happening at time 0. You want to sell the dollars and bank will buy the dollars. Dollar is the base currency, sir. That's why I'm talking in terms of dollar. You want to sell it, bank will buy it. Bid rate 0.9830. This is pound, this is also pound. Divide it. 333,659 divided by 0.9830. So the dollar requirement is 339429. This much of the dollar is required to be sold if you want to buy this pound. Now, if you have to sell this dollar, you will have to borrow it first for selling it. So $339,429 you will borrow for 3 months. So dollar borrowing rate 13% for per annum and 3.25% for 3 months. Add 3.25% in this, and that's your outflow in the money market. 350,460 dollar. That's it. This is the money market. 350,460. Let's try. Easy. It's now very easy. And I'm leaving this euro wala part with you. This is an easy one to calculate because the rates are also direct in terms of euro. Forward market, money market, you can finish the transaction. And the answer is, see, in case of a pound payable, money market hedge is cheaper option, and in this case, forward market is cheaper option. Okay, sir. Now we are going to solve the questions on currency swaps. We are done with the forward, futures, options, and money market hedging as well. I hope you liked the money market hedging part, options part, futures. We had a very few questions on them, and lots of questions on the forward from the start till the end, and still there are few more questions on the forward under FedI guidelines. Okay, this is question number 87, which includes swapping. Swapping has been learned by us, discussed by us in the interest rate risk management chapter. Same are the concept here. First of all, you should understand that swapping is over the counter market traded contract. So there are no rules for that. No regulations for that. It all depends upon the parties involved under the swapping, how the transactions will happen. But one thing has to be known, noted, that both the parties should gain something from the swapping. Otherwise, there is no benefit of entering into a swapping. If one party is not gaining and the other one is gaining, then still there is no benefit of entering into a swapping transaction. So if we both are there, let's say for example, if we both are agreeing to enter into a swap agreement, we both should get benefited out of this. Even if one of the parties is not being benefited, why he will enter into swap agreement and waste his time? Agree. A incorporation and B incorporation intend to borrow $2 lakh and $2 lakh in yen. That means both of them wants to borrow the dollar and yen loan, but the yen loan will be equivalent of $2 lakh respectively for a time horizon of 1 year. So the calculations will be easy. The prevalent interest rates are as follows. See, A incorporation wants to borrow dollar loan. That means the rate to him is this. He can borrow directly from the market at 9%. And B incorporation wants to borrow yen loan, and the rate applicable to him is 8%. If they do not enter into a swap agreement, directly goes to the bank, the rates are 9 and 8%. They will only enter into a swap agreement if there is a if B Incorporation's cost of yen loan is lower than 8% and A Incorporation's cost of dollar loan is lower than 9%. Agree? The benefit is only in the lower rates. Only then we have a reason to enter into a swap agreement. Otherwise, each party can directly go to the bank and have a loan at 9% and 8% respectively. So even if we are achieving like 1 or 2% of the profit or lower rate in loan, then still it is possible to go for the swapping. The exchange rate today is $1 is equal to 120 yen. Now understand, they entered in a currency swap under which it is agreed that, step by step I will go. Let me start the question. This is question number, I think, 87. So these two are banks. Okay. These two are the parties, A and B. The desired loan for A Incorporation is dollar and the desired loan for B Incorporation is yen. In swapping, understand that A wants a loan in dollar, and in case he goes to the bank and directly buy or borrow the dollar loan, then the swapping is not possible because he got what he wanted. Then there is no need to do anything with bank 2 or B Incorporation for A. So in order to do the swapping, it is only possible when we do the transaction. We enter into a transaction in opposite rate or opposite currency, or we exactly do the opposite thing of what we want, because whatever we are going to do here will be swapped with the other party so that we can get something which we want from the other party. Just a second. Okay, what will happen in this case? Obviously we want dollar loan, we will borrow yen loan from the bank A. Yen loan. If we get yen loan from bank A, we will have to pay yen interest rate to the bank 1. Okay, what is the yen interest rate of A Incorporation? 5%. So the outflow by us to the bank is 5%. Bank has nothing to do with what you guys are doing, right? You borrowed the yen loan from bank 1. You borrowed the yen loan and swapped it with B. You gave it to B, the yen loan. Now, similarly, B will borrow the loan on your behalf. That will be dollar loan. He will borrow dollar loan. So what will happen between A and B? Whatever A has borrowed from bank 1 will be given to B because B wants the yen loan. And whatever B has borrowed from the bank 2 will be given to A because A wants dollar loan. So both of them will get their loan principal value, whatever they wanted. Now, the B Incorporation will have to make a dollar interest payment to bank 2. What is that? See, B Incorporation's dollar rate is 10%. You can clearly see that. So B Incorporation will have to make a payment of 10% to bank 2. Now, what is the swap arrangement for interest rate between these two guys? Let's have a look. What is the swap arrangement for interest rate between these two guys? They entered in a currency swap under which it is agreed that B Incorporation will pay to A Incorporation. Step by step. B will pay to A incorporation. How much? 1% over the yen loan interest, which the latter means this guy. So read it like this. B will pay to A 1% more than the yen loan interest which A incorporation will have to pay as a result of the agreed currency swap. It means that whatever A is paying 5% to bank. Over and above what A is paying to bank, B will give 1% more to A. That means 6%. Simple. B will give A 1% over and above what he or A is paying to bank. So 5 plus 1, 6% will be given by B to A. That's the agreement. Now, whereas A will reimburse interest to B. Now A will pay something to B. How much? Only to the extent of 9%, clear cut. Doesn't matter what the other is paying. So this is how the swapping is done. Okay. Keeping the exchange rate invariant, that means constant. The exchange rate will be constant for the spot rate and after 1 year also. Quantify, underline this, you will have to actually calculate the values. The opportunity gain or loss component of the ultimate outcome resulting from the designed currency swap. See, if the word quantify would not have been given, I would have ended the question with a simple outflow and inflow of interest rate. Understand, the outflow of A incorporation is 5%. So A incorporation's outflow is 5%. Receipt is 6% and outflow again is 9%. These are the swap transactions which is happening for A incorporation. Ultimately, the outflow is 9 plus 5, 14 minus 6, that is 8%. Do you agree? So ultimately A incorporation is paying 8%. Ultimate cost to him is 8%. And he is using the dollar loan. In the beginning itself, B borrowed the dollar from bank 2 and gave it to A. So A incorporation is using $2 lakh and paying 8% interest under the swap. A incorporation is using $2 lakh and paying 8% interest under the swap. What would have been the interest rate if he would have directly borrowed it from the bank? 9%. So isn't it better that he is only paying 8% and still using the same amount of loan? Exactly. So there is a gain of 1% to A incorporation in this case. If the A incorporation directly goes to the bank, it will cost him 9%. But if he arranges for the swap, it is costing him only 8%. Let's talk it from the angle of this is called as swap rate. I will just shift everything here. So this is a swap rate. What was the direct rate without swap? It was 9%. And this is the gain due to swap, 1%, because he has to pay less, 1% less in the swapping and still using the same amount of loan. Let's talk it from the angle of the B. B is paying 10%, paying 6% as well. 10, 6 and receiving 9. 16 minus 9, 6 and 3, 7%. This is the swap rate to B. What was the rate to B incorporation? Yen loan interest is 8%. So the direct rate to B was 8% and he is also gaining 1%. To both the parties there is a gain of 1%. So 1 and 1%, 2% is the total gain which was shared equally by both the parties. See, What is the difference between yen loan? 3%. What is the difference between dollar loan? 1%. And what is the difference between the difference of both the loans? 2%, which was shared equally. This is how we used to calculate the quality spread in interest rate risk management chapter. 2% was the possible gain, maximum possible gain, and that was shared by both of them equally. That's it. Now, that's not the end of the answer. This is not how you should present in exam, because the question clearly says that we have to quantify. That means we have to apply these rates on $2 lakh, exchange rate, yen amount, and then show the calculations. So there are two different ways of it. See what is happening now. A incorporation. How much loan A borrowed from bank 1? It's very simple to calculate. I will just do it here. He borrowed the equivalent amount of 2 lakh into 120. So the loan that he borrowed was 24 or 240 lakhs. So it was 240. So this is the principal amount that he borrowed from bank 1 and then swapped to B. He has given it to B. And bank 2, from bank 2, B borrowed $2 lakh, which was given to A. Now tell me one thing. When it's our time to make the interest payment of 5%, A will have to make the interest payment of 5% to bank 1, which will be on 240 lakhs yen. So 240 lakhs into 5% comes to 12 lakh. 240 into 5% comes to 12 lakh. So the outflow to A incorporation will be like this. This will be 12 lakhs given to bank 1. How much B incorporation will give to bank 2? 10% on the dollar. That's around 20,000. Do you agree? Okay. B will give to A how much? Over and above 1% on 5%. That means 6% will be applicable. Over and above 1% on this, na? And this is yen loan. So 6% on 240. So 14.4 lakh. In terms of yen, 14 lakh 40,000. It will be received by A incorporation and paid by B incorporation. Okay, sir. And how much A is going to pay to B? 9% for the dollar loan that he has given. These dollars was borrowed by B and given to A. On that he is paying only 9%. That comes to $18,000. Do you agree? Now just make the columns for A and B and write down the values in that. A incorporation. This is yen, this is dollar. Equivalent amount, we will call it as pay to bank 12 lakhs. This is equivalent of $10,000. You can divide this yen loan by 120. So why I'm calculating for A incorporation, dollar loan is the ultimate thing. So all the cost for A incorporation will have to be calculated in dollars. Even if he is paying 12 lakhs to bank, what I'm going to do is I'm going to divide it by 120 to find out what is the equivalent dollar amount. Receive from B 14 lakh 40,000 divided by 120. That means it is equivalent to receiving $12,000. Okay, let's put the symbols of outflow and inflow. So it is equivalent to receiving $12,000. We can get this much of the yen interest from B and convert it at dollars because the exchange rates are same. Then pay to B. How much we paid to B? $16,000. That's it. You can clearly see. Sorry, $18,000. Now, if you calculate in terms of dollar, 28 minus 12 comes to $16,000 dollar interest. And in terms of dollar percentage, it is $16,000 is the net cost to me on using $2 lakh. That comes to 8%. This is the swap rate. Direct rate was 9%. Gain due to swap is 1%. This is how you should present in exam at least. There are multiple ways of presentation, but this is the best you can do. For B incorporation, create a table like this, put dollar on this side, yen on this side, because ultimate cash flows to the B incorporation should be showed in yen. See, $16,000, $18,000, and the gain to him is 1% on $2 lakh. That is $2,000. And for B incorporation, it is like 16 lakh 80,000, 19 lakh 20,000. The gain is 1% on 240 lakhs comes to 2 lakh 40,000. So there are different ways of presentation. You can present it in any manner. So, and this is an alternative solution. You can just go through it. It will come to the same answer. 18,000, 16,000. Again this and this. Interest to A, net interest cost. Okay, sir, let's move on to question number 88. Easy. Swap questions are like whatever you are saying in the question, we will do it. It's all about the personal agreement between two parties. So customizations are possible, whatever you want to do. Question number 88 is again the currency swap question and the most interesting question. I like it. So I will take a break and I will be back in a minute to solve this question number 88. See you. So welcome back after the break. Now have a look on this question. This is an interesting one. Drill Dip Incorporation, a US based company, has won a contract in India for drilling the oil field. Filed or field? The spelling mistake is there. Okay. So a company from US will come to India, invest in Indian currency in India and drill the oil field. The project will require an initial investment of 500 crore. The oil field along with equipment. The oil field along with equipment will be sold to the Indian government at 740 crore in 1 year time. Okay. So the transaction is like this. Question number 88. This is the timeline. You will invest 500 crore today in terms of rupees. In the oil field, you are a US company coming to India, investing in rupees, and you will sell this project to Indian government at the end of 1 year for 740 crore. Now the owner will be Indian government and this has been decided from the very beginning. You will have a profit of 240 crore rupees for sure, but that's not the issue now. Since the Indian government will pay for the amount in Indian rupee, the company is worried about the exposure due to change in the exchange rate. Think from the angle of the US based company. Their home currency is dollar and all the transaction Indian government is doing is in rupees. When US based company will sell this project to Indian government, they will get rupees. So exchange rate risk is with the US company and they are worried about it. Okay. Now construct a swap that will help the drill dip to reduce the exchange rate risk. Construct a swap that will help the drill dip to reduce the exchange rate risk. Now how are you going to construct a swap? It's just simple thing, I will tell you. Let's say the drill dip company is coming to India. The very first thing that will happen is they will bring dollar. They will bring dollar and they will sell those dollar in India. In India or in US, but they will sell it to get the rupee value. They will receive the rupees. How much? 500 crore. So that this amount can be invested in the oil field. Investment is required in rupees. So first you will have to buy the rupees by selling dollars. And just imagine how the dollar will be sold by the US company. They will borrow the dollar in their own country. They will borrow X amount of dollar, will sell that dollar at spot rate and receive 500 crore. This 500 crore rupees will be invested here. Okay, you have to arrange a swap where Drill Dip Incorporation can reduce the risk. They are not saying that they are not saying to just remove the risk. They are saying reduce it to the maximum extent possible. So a type of swap that can be created is like this. Let's say, for example, we go to the Indian government or some other bank and we say that today we are selling you X dollars and receiving 500 crore rupees. Let's enter into a swap so that at the end of 1 year, out of this 740 crore, we will sell 500 crore back to you. Since we have received 500 crore from you, we will sell it back to you and you give us the X amount that we paid to you. This way, we will ensure that the X amount of dollar is secured. That means we are going to receive the same amount of dollar as we paid with the same amount of rupees. Today, we bought 500 crore rupees for X dollars. Tomorrow, we will buy X dollars for the same price. If the price is same, there is no change in the exchange rate for this much of the dollar. That means there is no risk of exchange rate on this much. This is how you can create a swap. Swapping means first you are paying the dollars for rupees and then you will receive the dollar for rupees. So you received rupees, you will pay it back. You paid dollar, you will receive it back from the Indian government. This is how you can create a swap. Now let's read it first. The swap of US dollar loan today at an agreed rate. The following swap arrangements can be made entered by Drill Dip. Swap a dollar loan today at an agreed rate with any party to obtain Indian rupees, that is 500 crore. After 1 year, swap back the Indian rupees with dollar at an agreed rate. At the agreed rate. Okay. In such a case, the company is exposed only on the profit earned from the project. That means only 240 crore will be exposed to the exchange rate fluctuation, because 500 crore which the company invested by paying this much of the dollar, it will be returned back. This much of the dollar will be returned back under the swap agreement after 1 year. So practically speaking, if they are bringing X amount of dollar in India, they are taking X amount of the dollar, the same amount of dollar from India. So there is no risk on the investment that they have made. The risk will only be there on the profit from this project. Okay, now the second part of this question. First part was all about theory. Assuming that Indian government offers a swap. Now Indian government itself is offering the swap. You understand? You will sell the project to the Indian government and Indian government itself is offering the swap at a spot rate of rupees 50 per dollar. In 1 year, the company should, then the company should opt for this option, or should it just do nothing? Should it just do nothing? Opt for this option means swapping. And just do nothing means no swapping. The spot rate after 1 year is expected to be 54. Further, you may also assume that Drill Dip can take a loan at 8% from America. All in all, I will tell you what will happen. Since today's rate is 50, the rate agreed between Indian government is 50. So in order to bring to buy 500 crore rupees, 500 crore divided by 50, US party, the company, will have to sell 10 million or 10 crore dollars to Indian government. The moment you will sell 10 crore dollars to Indian government at the rate of 50, 10 into 50, you will receive 500 crore that can be invested back, invested in this project. You will receive 740 crore from the Indian government itself by selling this project. Out of this 740 crore, 500 crore will be 500 crore will be given back by you to the Indian government, and you will get back 10 crore dollars. So you can clearly see that the amount you invested in the country or your home currency is being received by you after 1 year itself. So this is the swap arrangement. So that there is no risk. 10 crore dollar invested, 10 crore dollar received back. No risk of principal amount at least. Only 240 crore will be exchanged at a different rate. What will happen to the 240 crore rupees? Sir, 240 crore rupees was not agreed under any swap arrangement. It was unhedged. This 500 crore was hedged under swap agreement. This is unhedged. What are you going to do with that? You will sell it at the spot rate after 1 year, which is 54. You will receive 4.44 crore dollars. So there are two receipts to you, 10 crore and 4.44 crore, totaling to 14.44 crore. And out of that, you will make a repayment. You sold 10 crore dollar in the beginning, which you borrowed from America. You will have to make a repayment of that at 8%. The repayment will come to 10.80. So out of this 14.44, you will have to make a payment of 10.80. This is the entire transaction. Now I am finalizing whether we should go for it or not. This is swapping and this is no swapping. I will tell you what are the transactions that will happen at time t0. This is rupees, this is dollar, this is rupees, this is dollar. Everything is in crores. Okay, understand what will happen at time 0. Borrow. You will borrow money from America. How much? $10 million or 10 crore dollars, sorry. Okay. Then you will sell dollar and buy rupee. How much? 500 crore rupees will be bought by you by selling 10 crore dollars. Do you agree with this? And then what are you going to do? You will invest. How much? 500 crore. And the same will happen in this case. Swapping will be done later on. Now, the net is 0 today. See, if you do the swapping or do not go for the swapping, the investment in the oil field requires 500 crore. For that purpose, you will have to sell 10 crore dollars today at the rate of 50. And this 10 crore dollar has to be borrowed. So these cash flows will be same in both. What will happen at the end of year 1? Sell this project to Indian government. The moment you will sell the project to Indian government, you will receive 740 crore in both the cases. And now you will see the difference in both the options. We will write down settle swap. What do you mean by settle swap? We will pay 500 crore back to the government because we received it under swap. And we will receive 10 crore dollars as agreed under swapping. But nothing will happen if you don't go for swapping. There is no settlement of swap. And spot sell. What do you mean by spot sell? The balance left after 740 crore, after the payment of 500 crore from 740, will be sold in the open market at a rate of 54. and we will receive 4.44 crore of the dollars. See, this is how it is happening. We sold the project at 740 crore. Out of that, 500 crore was used for settling the swap, and the balance left was sold in the spot market, open market, at the open rate or the spot rate. Okay, but if you don't go for the swapping, the entire 740 crore has to be sold in the open market. So you will sell 740 crore, 740 at divided by 54, and this way you will receive 13.70 crore dollars. 13.70 crore dollars. 740 divided by 54. Yes, and see the net cash flows. Acha, one more thing which is left. You will have to make the repayment of the borrowings. Dollar borrowing. How much? 10 crore dollars that you borrowed at the beginning will have to be paid at 8% interest. That is 10.80. 10.80. Do you agree with this? It should be written in the dollar column. So rupee dollar, rupee dollar. Now you can clearly see this part of the rupee will get 0 because we don't need, we are a US company, we don't need rupees in our portfolio. Do the total of dollars. 14.44 minus 10.80. If you do the swapping, the balance left with you will be 3.64 crore, and if you don't go for the swapping, the balance left with you will be 2.9 crore dollars. Now you choose which option is better for you. Obviously the option of swapping is better for us because we are getting more money in that case. This option is better, 3.64. Do you understood? Like, have you understood this? Very easy. At time 0, whether you'd go for the swapping or no swapping, all the transactions are same. You will first borrow from the US market, sell it in the Indian market to buy 500 crore rupees. And what happens if you do the swapping? This entire amount of 10 crore dollars will be swapped by you with the government. And in this case, in no swapping, you will sell that 10 crore dollars in the spot market. You will get 500 crore. And that 500 crore will be invested in India in the oil field. The same will be sold to the government after 1 year in both the cases. But here now we are going to see we will see the difference in the swapping and no swapping. Out of 740, we will pay back the government under the swap agreement 500 crore, and the balance will be sold in the open market. But there was no swap agreement in this case, the other case. And so entire 740 crore will be sold in the open market. Repayment of the borrowing is same in both the cases, 3.64, 2.9. Everything is in crore. But what institute has done is they have calculated everything in millions. So million means 10 extra. 10 extra. So if you apply 10 extra to this, it is 36.4 millions. It's like 36.44 million. And in the other case, 29.04 million. This is 29 million. If you take it in millions. So the answer by the institute is same. What I suggest is that whatever the format of the question is, follow that. In the question, crores have been given, so you should use the crores. I understand that in dollar currency there is no concept of crores. In the dollar currency there is a concept of millions, billions. But go with the question. You have to follow one. This was question number 88, and the last question before starting the FEDI calculations or the FEDI rules, before discussing the FEDI rules. This is question number 89. Let's have a look on this. Okay, see, this is going to be the last question of this lecture. Interesting one. On 1st February 2020, XYZ Limited, a laptop manufacturer, imported a particular type of memory chip from South Korean company. Imported. SKH Semiconductor of South Korea. The payment is due in 1 month from now, amounting to 1190 million South Korean won. SKW. This is the amount that you have to make the payment to the party after 1 month. So you need to buy SKW. What do you want to do after 1 month with the bank? You want to buy SKW 1190 from the bank and sell INR. Am I right? You want to sell INR in that case. Following spot exchange rates are quoted in two different markets. You can see that the direct rate of SKW with INR is not given to you. Okay. USD INR, USD SKW is given, and if you will look closer to the rates, these are given in terms of ISO codes. So it has to be read like this: 75 INR per dollar, 1190 SKW per dollar. Dollar is the base currency here. So whatever you want to decide in terms of US dollar. Okay. Since hedging of foreign exchange risk was part of the company's strategic policy and no contract for hedging in SKW was available at any inshore market, you can see that only spot rates are given. Forward rates for SKW is not given, not even in the cross market as well. Okay. And no contract for hedging is available. It approached an offshore market. Out of the country, he approached someone for non-deliverable forward market. Now what happens in the non-deliverable? This is a forward market, but it is non-deliverable. That means if you enter into a forward contract, what you have to do at the end is close it, square it off. There will only be cash settlement. This forward contract does not mean the delivery will happen. There will be no delivery of SKW in this contract. This can be just used like a futures contract. In the futures contract, you open a position, you close a position by the opposite action, and the cash settlement happen. In reality, if you want to buy SKW, you will go to the spot market itself. So this forward contract can only be used to reduce the loss. If there is a loss in spot market, there will be some profit in the forward market and you can reduce some kind of loss. Non-deliverable simply means SKW cannot be delivered at this rate, forward rate. It has to be closed with a reverse transaction. Okay. In NDF market, a dealer quoted 1 month USD by SKW rate, and you can see USD is the base currency here. So before picking up the rate from the bid and ask, you have to decide what do you want to do with the dollars. You want to buy SKW, right, and sell US dollar. If you want to sell US dollar, bank will buy US dollar, which is the base currency. And if the bank wants to buy US dollar, the rate applicable will be this bid rate. This is how you have to pick the rate. Because I can clearly see that USD is the base currency. USD is the base currency. I will have to decide in terms of US dollar. I want to buy SKW, sell US dollar. Bank will buy US dollar at a bid rate of 1190. Okay. For a notional amount of USD $1 lakh to be settled at a reference rate declared by the Bank of Korea. This has to be settled because of a non-delivery. After 1 month, the bank declared the rate, which is SKW 1185 per USD. In this case, there is no bid and ask, so directly we can use this rate. So 1190 and 1185 will be the rate. This is our selling rate, sir. Please understand, selling for US dollar. Selling for US dollar. And this will be your buying rate. So practically speaking, you are gaining 5 SKW per dollar of the contract that you have entered into for selling. 5 SKW per dollar is the gain. We can clearly see that we wanted to buy SKW, sell US dollar, and since we want to sell US dollar, bank will buy. So we want to sell US dollar, we will sell forward contract today. That is how we decide forward futures and option. Whatever we want to do with the base currency at expiry, we are going to do it today with the forward futures and option. We want to sell US dollar, sell forward. That's how we opened the sell contract in the NDF and then closed it at buy contract. So selling at 1190, buying at 1185 will result into 5 SKW profit of 5 SKW per dollar as rate for settlement and on the same day of the spot rates in the above market were as follows. So on the same day means on the 1st March. You started the transaction on 1st February. This is the due date and the due date of the spot rates are given. Spot rates of the due date are given to you. Analyze the positioning of company under each of the following cases comparing with the spot position on 1st February. That means this position. If you do nothing, what will happen? If you do nothing means you don't take the NDF contract. You don't do the hedging. If you will go for no hedging, calculate the cash outflow at today's spot rate, cash outflow at tomorrow's spot rate, the profit and loss will be there if you don't do anything. But if you opt for the NDF contract, you will calculate the cash outflow at today's spot rate because the question is asking you, and then do it for the tomorrow spot rate plus minus whatever is the profit in the NDF contract. So practically speaking, this question has two things common: spot rate, spot rate, spot rate, spot rate. So whatever is this cash flow, let's say X, it will be again repeated here plus minus whatever is the profit and loss of NDF contract. Simple. Okay. These things has to be kept in mind. Note that both rupees per SKW rate and final payment to be computed in lakhs, rupees in lakhs, to be rounded off up to 4 decimal points. Okay, sir. Let's start the transaction. What kind of rate is required? Because we have to calculate the cross rates. Now, let's write down in ISO format SKW INR. So SKW is the base currency in this rate. We want to buy SKW. Bank will sell SKW. So bank's selling rate, that means ask. Am I right? For SKW. If I write INR SKW, then I would have written bid because I want to sell INR and bank will buy INR. So bid rate of INR. This is selling rate of SKW because bank will sell SKW to me. I will buy SKW. Okay. Create a cross rate. Ask of SKW will be written first because it is for the first year, and the second or the third currency, which is US dollar, into again ask of start with the third currency, which is US dollar, and the second currency INR. This is how the USD will get cancelled by writing last in the first quote and first in the last quote. Okay. If you will look at the just a second. Let me close this one of the two. Okay. So the first rate is you need SKW USD. You need a quote where SKW is base currency, USD is price currency, but the same is not given here. You can clearly see USD is the base currency as compared to SKW. So what do we have to do? We have to reverse this transaction in order to match with what is given in the question. SKW is not first now. So we will reverse it. 1 divided by. Whenever you do the reverse of a a quote, ask becomes bid and bid becomes ask, USD SKW. Now do you think it is looking exactly like what we need? USD SKW and USD SKW. So you have to take the bid of it. And the second rate is required is USD INR, and the USD INR itself is given. You can see here USD INR is given. So we can take the ask of that. Okay, let's start putting the values. Okay, now we will calculate the cross rate first for spot of 1st February. Okay, 1 divided by bid. See, bid of this and ask of this. Let me change the color. Bid of this and ask of this. Am I right? 75 point. I will just write it straight away. 75.50 divided by 1190. and this will give you 0.0634. Question clearly asked us to limit the decimals to 4. So this is nothing but 0.063 rupees per SKW, today's rate. And spot of 1st March. Let's go to this. Again the same rates. The ask of USD INR and bid of USD SKW. So 75.75 divided by 1188. 0.0638. So this is what is this? This is INR per SKW, and we want to buy SKW. If we would have bought it at 1st of the February, this would have been the INR outflow by us. But now we are buying it at this. That means this will be the INR outflow for us. So we can clearly see that as compared to 1st February, we have to pay more INR. In place of 4, there is 8. We have to pay more INR for SKW. There is a loss. Clear loss. But I will compare it with SKW, required SKW 11,900. 11,900. Why 900, sir? It's very simple. 1190 is in millions, and if I have to convert it in lakhs, I will just multiply it with 60. Multiply means add 60 in front of 1190 and then divide it by 1 lakh. That comes to 11,900. So the outflow in terms of rupees at 1st February would have been 754.46, but actually it is 759.22. And how much we are losing? 4.76 lakhs. Everything is in lakhs now. This is rupees, this is rupees, this is rupees. So if we do nothing, you can clearly see that, if we do nothing, we have a loss of 4.76 lakhs. Let me explain. If we buy 11,900 lakhs SKW on 1st of the February, it would have cost us 754.46 lakhs rupees. But now it is costing us 759.22 lakhs, and that's a loss if we don't do anything. But if we take the NDF contract, now understand, step by step I will write it. And what will happen under NDF contract? Asset under NDF contract is US dollar. Okay, because USD was the base currency, you can clearly see it from here. See, USD SKW 1190. So USD is the base currency in this case. So what do we want to do? We want to buy SKW, right? After 1 month. That means we will sell the other currency, which is US dollar. Simply. And since this is the base currency, we want to sell base currency. See, what will happen, since we want to sell USD, we will sell NDF. We will start by selling NDF. Sell NDF. In that, what will happen, I will tell you. 11,900 divided by the rate is, you will start by selling at 1190. This is the rate. Do you agree with this? Because you want to sell US dollar, bank will buy US dollar, and 1190 is the bid rate. Okay. So 11,900 is your SKW value. 1190 is the rate. Both of them are SKW, and this will give you 10 lakhs dollar. So what will happen, I will tell you. You will sell You will actually buy 11,900 SKW by selling 10 lakhs US SKW US dollar. You wanted to sell dollar and buy SKW. So how many SKW will you buy by selling 10 lakhs US dollar? 11,900. And on the other day you will close the NDF at the same rate, 11,900 divided by 1185. You will sell all the 11,900 SKW. Sir, why are you selling SKW? We have to make the payment to the other party. Please understand, this is non-deliverable forward contract. Whatever you bought cannot be delivered to you. So you will have to close it. Whatever you bought, it cannot be delivered to you. You will have to close it. So 11,900 divided by 1185. The amount of dollars that you will receive is 10.042 and 10.0422, 4 digits. So you can clearly see that there is a gain in NDF for US dollar. How many? 0.0422 lakhs. This much of the US dollar benefit is to you. 0.0422 lakhs. What you did in NDF is very important to understand. Asset under NDF was US dollar. You wanted to buy SKW by selling US dollar. So we tried that 11,900 is the SKW amount that we have to buy at this rate. So how much US dollar we will have to sell? 10 lakhs. Okay, we sold 10 lakhs US dollar. This is all notional amount. Please understand, no delivery is happening in the entire, no one is paying or receiving US dollar in reality or SKW in reality. So 10 lakh US dollar sold, 11,900 SKW bought. Since the delivery is not possible, we will sell it again at 1185 and we will get 10.0422 US dollar. So the gain in US dollar is 0.0422 at 1st of the February. Sorry, 1st of February is this and this is 1st of March. So on 1st of March we have a gain in US dollar in terms of rupees lakhs. 0.0422 lakhs gain. What are we going to do with this US dollar gain? Sir, simply sell it in the market. These are the spot rates. These are the USD INR spot rate. You want to sell US dollar gain, bank will buy it at 75.50. Spot rate 75.50. Gain in rupees lakhs. Hmm? 0.0422 into 75.50. So that will be 3.1861. That's it. Now what will happen? In the very first case when you did nothing, these two were the we can say cash flows, or we can say this two would have been the cost. On 1st of February the cost was 754, on 1st of March the cost was 759. But with the help of NDF you can reduce this cost 759, because this is outflow 759 lakhs 22,000 and this is inflow, this is a gain 3.1861. Now let me just go directly to the answer. Let's check the answers now. We have calculated everything now. See, do you agree with these two values? First of all, when we do nothing, 754.46, 754.46, and on this 1st February and on 1st of March 759.22, 759.22, the loss of 4.76 lakhs, 4.76 lakhs. Now what is happening? Just understand here. When you do the hedging, the mistake that they have did is question clearly asked us to do the calculations in terms of lakhs, but they are writing the entire value. So this is 10 lakhs. Do you agree? This is 10 and this is 10.0421 or 22. So this is what we have written here. 10 sold and 10.0422 received. Okay. So what is the benefit? 4,000 4,219 of US dollar. And what are we going to do with this 4,219? We will sell it in the spot market of 1st March and we will receive a gain of 3.1853 lakhs. Understand, this is a cash inflow to us because it's a gain 3.1861. On the same day, we are going to buy 11,900 SKW at spot, which was the earlier amount of 759.22. Just understand, this is the 759.22. Because no matter what you do in the NDF contract, whether it is a gain or loss, you will have to buy the 11,900 in order to make the payment to the South Korean party, and that's 759.22. So that remains the same. Only thing that the NDF is doing is NDF is reducing your cost at 1st of the March. This is less. So 756, it is coming to 756.0347. Now understand, 756.0347 and this earlier price now will be compared. That's it. If you want me to summarize, I will just show you. Or we can clearly get the values from here. 754.46, 754.46, 759.22, 3.1861 outflow, that's 756.0339. Now these three values are important. For the first calculation when you do nothing, these two are important, and for the last calculation when you do NDF contract, when you enter into NDF contract, then these two are important. So let's calculate the profit or loss in both the cases. The profit or loss in these two when compared with these two, just delete it, man. Was 4.76 lakhs. Do you remember? That was the loss. Now what is happening? The loss is getting reduced. That's it. The difference between these two, 756.0339 minus 754, 1.579. When you do nothing, the loss is 4.76 lakhs. When you take the NDF contract, the loss is 1.5739 lakhs. This loss of 4.73 lakhs is offset by the profit of 3.1861 lakhs. That's what the story is. That's it. Due to NDF, this is the gain due to NDF, 3.1861 lakhs. Now I hope you understood everything. In the second part, these two are common. No matter what you do in the NDF, it will only be settled in cash. So ultimately, when there is a need to really buy 11,900, in both the option you are incurring this cost of 759.22. You are going to the market to buy the 11,900 SKWs. This is just a nominal thing if you would have purchased at 1st of the February. So this is all in all the entire question. 1.5739, right? Let's just find out. 1.5747, rounding of differences. So this and this, which option will you opt for? Obviously NDF is giving me a profit. If the only question in this only thing that the question wants to ask is whether we should go for NDF or not, then this much of the calculation is enough. You have to do nothing. No other calculations is required, because this part is repeated again in the second part. So it has no relevance in the decision making. If NDF is giving profit, as you can see it here, then we should go with the NDF. Otherwise, we should not, because apart from this, everything else is same. Okay, sir, we'll finish this question now, and from question number 90, we are going to move over to the, just a second, not the chart, this, I want to open this. So we are done with question number 89, and now you can see from question number 90, we will be dealing with the forward contracts, delivery, cancellation, extension, delivery, cancellation, extension, on due date, before due date, after due date. There are 9 things that we are going to learn with the help of a proper table, and this entire concept will go on till 107th question. Probably the second last topic, and the last topic will be nostro, vostro and loro account. That's the easy one. But the most difficult part under the forward contract will be this early delivery transactions and late extension transaction. So that's why I have put it in the end. So we'll start with the easiest question. The first question like 91, 92, 93, these are the easiest one. But then slowly we will start increasing the difficulty level, and early delivery and late extension contracts calculations will be the most difficult in this, and you will have to understand it. Take a break, have a nice sleep. Right now I'm recording the time that I'm recording, like I'm going to finish the recording is 12:14 a.m. So I was there in the office from 10 o'clock in the morning, and I'm recording continuously. Okay, sir. We'll come back tomorrow in the next lecture, and we'll start with the forward contract related concept. See you.